The mainstream financial press has been telling the same story for a decade. Spain bounced back. Record tourism numbers, GDP growth above the European average. Unemployment was cut in half. The Eurozone's great comeback story, the proof that austerity worked, every single word of that is a lie. What you're actually looking at is a Potemkin economy, a perfect facade constructed by central banks, political institutions and global capital, specifically engineered to look like recovery, while the structural rot underneath compounds every single year. And there are 8 specific mechanisms keeping this illusion intact. Fake employment statistics conceal a generation of disposable contracts. Real wages have silently collapsed in purchasing power. Foreign capital that quietly bought the entire housing stock. Zombie corporations surviving on artificially cheap debt. A demographic catastrophe is accelerating in silence. A tourism dependency guaranteeing permanent national poverty. Coordinated institutional deception from Brussels to Madrid, and a specific trigger event that the people engineering this facade are already preparing for, while the citizens are left completely exposed. The cracks in this structure are not forming, they are already spreading. By the end of this video, you will never read an economic recovery headline the same way again. But first, at what point in the last decade did you personally feel that the recovery never actually reached you? The government called it a miracle. By 2023, official unemployment had fallen to its lowest level in 15 years. The headlines wrote themselves: Spain was hiring again. But here is what those headlines refused to print. Spain still holds the highest unemployment rate of every OECD economy in the world. At roughly 11%, the national jobless rate is almost double the European Union average, and that number is the polished version. Underneath it sits the real architecture of Spanish employment. The 2022 labour reform, celebrated across European institutions, technically reduced the proportion of temporary contracts. But the mechanism used to replace them was not permanent work in any meaningful sense. It was something called the contrato fijo discontinuo, a so-called permanent contract that guarantees no fixed hours and no guaranteed schedule. Lawyers and statisticians classify it as permanent. The worker living on it knows the truth. It pays when the season demands it and disappears when the season does not. These contracts multiplied more than 8-fold between 2019 and 2025. Meanwhile, youth unemployment remains close to 28%. Nearly 9 in 10 new jobs created in 2024 went to immigrants, who earn on average over €500 a month less than native Spanish workers. The labour market is growing, but it is growing at the bottom, padded with low-wage, low-security positions that generate social security contributions without generating anything resembling a stable life. Spain is not creating a workforce. It is manufacturing the statistical appearance of one. Even if you accept the job numbers at face value, the next question is what those jobs actually pay. And here the story gets considerably darker. The average Spanish worker in 2025 earns almost exactly what the average Spanish worker earned in 2018, in real terms. Gross wages have risen by approximately 0.2% in real terms over that entire 7-year stretch, a period that included a global pandemic, a historic inflation crisis, and what the European press described as an economic renaissance. 0.2%. During that same period, Spanish house prices surged by over 29% in real terms. The gap between what workers earn and what a home costs has not merely widened. It has become structurally unbridgeable for an entire generation without significant inherited wealth. In major cities like Madrid and Barcelona, rent alone now consumes more than 40% of the average salary. The OECD placed Spain among the countries where real wages declined most in the post-pandemic period. The government points to minimum wage increases, and those increases are real. The minimum wage rose by 54% between 2018 and 2024. But the minimum wage is not the median wage. Raising the floor does not rebuild the middle. What it does is compress the bottom, while the top remains structurally disconnected from the costs faced by the people below it. Spain's workers are running harder, the finish line is moving faster, and the wage trap and the job trap are only symptoms. The infection runs deeper. What was done to the Spanish housing market after 2008 was not a market correction, it was a controlled transaction. And it was not accidental. When the 2008 crash arrived, Spain did not simply experience a housing correction. It experienced a controlled transfer of assets on a scale that most Europeans still do not understand. Over the 5 years that followed the crash, Spanish banks processed more than 600,000 foreclosures. Hundreds of thousands of families lost their homes. Those repossessed properties did not flow back into the open market. They were sold in bulk, cheaply, to international investment funds. Blackstone, the American private equity firm, moved in at scale. It became one of the largest landlords in the country, using acquired stock to build high-end rental portfolios priced deliberately beyond the reach of the communities they had displaced. New construction, meanwhile, collapsed and never recovered. In 2006, Spain started construction on over 660,000 homes. By 2013, that number had fallen to fewer than 30,000. The builders who survived became so scarred by the crash that even as the population grew and demand rebuilt, supply never followed. Today, Spain needs an estimated 250,000 new homes per year. It is building fewer than half that number. The result is a housing market that surged over 11% in the 12 months to early 2025, the fastest pace since 2007. Prices in real terms are now near pre-crash bubble levels. The Bank of Spain has flagged active overvaluation. A generation priced out of ownership is trapped in a rental market controlled not by small landlords, but by institutional capital that bought the country's misery at a discount. While the housing market was being quietly reallocated, something equally important was happening inside the Spanish corporate sector. Companies that should have failed did not. The European Central Bank's extraordinary interventions after 2008, and again after 2020, flooded European credit markets with cheap money. Interest rates collapsed to near zero. For a decade, the cost of carrying debt was essentially free. This mattered enormously for Spain, because its economy is disproportionately composed of small and medium-sized enterprises, many of which had accumulated heavy debt loads during the construction boom and never fully deleveraged. The mechanism keeping these firms alive was not productivity. It was not innovation. It was the ability to roll over debt cheaply, year after year, without ever generating enough margin to service it under normal interest rate conditions. Economists call these firms zombies. They consume capital. They crowd out credit that would otherwise flow to productive startups. And they hold wages down in every sector they occupy, because their survival depends on keeping labour costs permanently at the floor. When the ECB began its aggressive rate hiking cycle in 2022, the cheap debt lifeline sustaining this sector suddenly became expensive. The true scale of corporate fragility in Spain began to surface. Spain's public debt stood at over 100% of GDP entering 2024, and the private debt dynamics underneath that number were no more reassuring. The question was never whether the cracks would appear, it was only when. But Spain's fragility does not end with its balance sheets. There is a clock running underneath the economy itself, a demographic clock. It has been running since before the crash, and almost nobody in power wants to say what happens when it runs out. Spain's total fertility rate in 2024 was 1.12 children per woman. The replacement level required to sustain a stable population is 2.1. What that gap represents is not a statistical footnote. It is the structural erosion of the very workforce expected to fund one of the most expensive pension systems in Europe. The median age in Spain is now 46.8 years. Every single person added to the Spanish population since the year 2000 has come through immigration. The native population has been contracting for decades. And while immigration has sustained headline numbers and propped up short-term labour force growth, it has not solved the fundamental arithmetic of the pension system. A significant portion of immigrant workers is concentrated in low-wage sectors that generate limited social security contributions relative to the pension obligations accumulating above them. The OECD has calculated that pension spending alone is projected to rise by 3.2 percentage points of GDP between 2023 and 2050. Aging-related costs in total, including healthcare and long-term care, could increase by up to 5.2 percentage points. Against a backdrop of public debt already above 100% of GDP, these are not sustainable trajectories. The government's own pension reform includes what is called an escape clause, a provision allowing the system to be adjusted if it drifts out of balance. That clause exists because the actuaries know what the politicians will not say publicly. The pension system is not designed for the population Spain actually has. It was designed for the population Spain used to have. In 2024, Spain welcomed 94 million international tourists, a record. The government declared it proof of the country's enduring competitive advantage. Every major outlet ran the same headline. What none of them asked is what 94 million tourists actually produce for the people who live there. Tourism accounts for roughly 12 to 13% of Spanish GDP. It is the backbone of the recovery story. But it is also one of the lowest productivity economic models a developed nation can adopt. The jobs it generates are seasonal, fragile, and structurally low wage. 71% of domestic service workers in Spain are immigrants. The sectors anchored to tourism, hospitality, short-term rentals, food service, and coastal retail sit at the bottom of the national income distribution and are the last to benefit from productivity-linked wage growth. More damaging still is what the tourism model has done to housing. In coastal cities and island communities, short-term rental platforms and foreign buyers have systematically converted residential housing stock into visitor accommodation. In Malaga, in the Balearic Islands, in Barcelona, young local workers are being priced out of the neighbourhoods they grew up in to make room for platforms that extract money from the city and send it to institutional owners headquartered elsewhere. Spain has built its recovery on a low-margin, high-volume service economy. That is not a recovery. That is a poverty trap wearing a suntan. But every number in this video, every uncomfortable statistic has been available to the authorities managing the system, which raises one question that cannot be avoided. If they can see all of this, what exactly have they been doing with the information? Spain's GDP per capita today sits at approximately 85% of the European Union average. The gap between Spain and the EU core is 15 percentage points. That gap has not moved meaningfully since 2008. What the ECB's bond buying programs achieved was to decouple the cost of Spain's sovereign debt from its structural performance. For over a decade, Spain borrowed at rates that bore no relationship to its underlying vulnerabilities because the ECB was the buyer of last resort. That mechanism suppressed the signal. The bond market, the mechanism designed to impose discipline on irresponsible fiscal behaviour, was rendered inert. The data was never hidden. It was published in official reports, in IMF consultations, in European Commission reviews. The gap between the documented reality and the political narrative broadcast to citizens was not an oversight. It was the policy. Every structural fragility in this video has a specific moment of exposure. The question is, what event pulls the pin? The first candidate is trade. The United States government introduced sweeping tariffs on European goods in 2025, targeting sectors where Spain carries meaningful export exposure, including automotive and agriculture. A sustained escalation of transatlantic trade friction directly compresses GDP growth, tightens the fiscal space required to manage pension obligations, and amplifies the strain on an already fragile corporate sector. The second is the ECB's rate trajectory. The institution that spent a decade keeping Spanish borrowing costs artificially low has been navigating a delicate unwinding. Any sustained return to restrictive monetary conditions driven by persistent services inflation or a renewed energy shock would expose zombie firms, compress the housing market, and immediately increase the cost of rolling over Spain's 100% of GDP public debt. The third is the housing market itself. The Bank of Spain has already flagged overvaluation. Prices surged over 11% in a single year through early 2025, mirroring the trajectory of 2006 and 2007 with uncomfortable precision. If credit conditions tighten or confidence shifts, the same market used to construct the recovery story becomes the mechanism of its unravelling. None of these is a remote scenario. They are the base case risks discussed in every serious institutional review of the Spanish economy. The difference between an IMF footnote and a crisis is usually one unexpected quarter of accelerating data. The fuse is not theoretical, it is already lit. So what do you do when the system cannot be trusted to protect you? When the institutions managing the dot are the same ones managing the narrative? That is where this story has always been heading. You did not come to this channel to be told that everything is fine. Everything is not fine. Spain is an economy that exchanged genuine structural reform for statistical theatre. A generation of working people was handed seasonal contracts and told to call it stability. A housing market was sold to foreign capital and told it would trickle down. A pension system was inflated beyond its actuarial limits and told that immigration would fill the shortfall. A tourism-dependent service economy was called a competitive advantage, and a set of institutions with full access to the real numbers looked at all of it, calculated the consequences, and kept the narrative running. What you now understand is not just the Spanish story, you understand the mechanism. The same architecture of managed decline, institutional opacity, and statistical performance exist inside almost every developed economy that has reached the limits of genuine productive growth. They generate GDP figures, they manage bond spreads, they publish recovery statistics, and they protect the balance sheets of the entities sophisticated enough to see through the numbers, while the working population absorbs the consequences of the reset that follows. The single most powerful thing you can do is stop consuming the narrative and start following the capital. That is what this channel exists to do. If this video gave you a framework you will carry forward, subscribe, drop a comment below telling us the specific moment in this video where something shifted for you, where the official story stopped adding up. That comment section is always more honest than the press conference. Stay sharp, we will see you in the next one.